Subject: Jerome Kerviel. Societe Generale Jerome Kerviel had a problem. The problem was not that he lost $7 billion in a single day. The problem was that nobody knew he had it until it was already gone. Let me introduce you to a man most people outside of France have never heard of. Jerome Kerviel, born in 1977 in a small town in Brittany, France. Not rich, not connected, not from a banking family. He studied finance, got decent grades, and in the year 2000, he lands a job at one of the oldest and most respected banks in the world, Societe Generale, founded in 1864. One of the pillars of French banking, the kind of institution that has survived world wars, economic crashes, and political revolutions. Jerome does not start on the trading floor. He starts in the back office, the part of the bank that most people never think about. The team that processes trades, checks records, manages the paperwork behind every deal the traders make. It is not a glamorous job, but it teaches Jerome something that most traders never learn. He learns exactly how the system works from the inside. Every check, every control, every red flag the bank uses to catch mistakes or fraud. He spends 5 years in that back office. Then in 2005, they move him to the trading desk. And that is where everything changes. The trading desk is a different world, loud, fast, competitive, the kind of place where your value is measured every single day by one number, your profit and loss. Jerome's job is to trade on European stock index futures. That means he is betting on whether the European markets, the German DAX, the French KC, the broader Euro stocks, are going to go up or down. These are not small bets. We are talking about positions worth hundreds of millions of euros. Jerome is good at it. He makes money for the bank. Not extraordinary numbers, but consistent, solid. But Jerome wants more. See, Jerome is watching the traders around him, the ones making the real money, the bonuses, the recognition, and Jerome believes he can do what they do. He just needs a bigger position to prove it. So he starts doing something he is not supposed to do. He starts making unauthorized trades, trades that go beyond his approved limits, bets far larger than the bank has cleared him to make. Small at first, then bigger. And here is where his 5 years in the back office become the most dangerous thing about him. Jerome knows every system the bank uses to catch unauthorized trading, every alert, every threshold, every cross-check. So he builds a system to fool all of them. He creates fake hedges. When you make a big bet in trading, the bank expects to see a counterbalancing position, something that limits the risk. Jerome creates the appearance of these counterbalances using fictitious transactions, fake trades, shell entries in the system that make it look like his risk is controlled when it is not. He uses login credentials of colleagues. He manipulates trade dates. He cancels and re-enters transactions to stay just under the detection thresholds he learned about in the back office. It is not sloppy work. It is meticulous, calculated, and it works for 2 years. By the end of 2007, Jerome Kerviel has built up a secret position in European stock index futures worth 50 billion euros. Let that number land. 50 billion euros. The entire market capitalization of Societe Generale, the whole bank, was around 35 billion euros. One man at one desk had secretly bet more than the entire value of the institution he worked for. And nobody knew. Jerome's entire position was a bet that European markets would go up. In January 2008, they did not go up. The global financial system was beginning to crack. The American housing market was collapsing. Fear was spreading through markets worldwide, and European stocks were falling. Jerome's 50 billion euros position was losing money, fast. But Jerome was not panicking. He had been in positions that turned against him before and recovered. He believed the market would come back. Then on January 19, 2008, a routine check by the bank's risk management team flagged something unusual. A counterparty on one of Jerome's trades, a bank on the other side of a deal, contacts Societe Generale to confirm a transaction. The transaction does not exist. The bank starts pulling on that thread, and the entire thing unravels in 48 hours. When the senior executives at Societe Generale see what Jerome has built, they cannot believe it. 50 billion euros in exposure, hidden for 2 years by one junior trader. They immediately contact the French banking regulator. The decision is made to unwind the position, to close out every single one of Jerome's trades as quickly as possible to stop the bleeding. But here is the brutal reality of financial markets. When you have 50 billion euros in positions and you need to sell all of it, you cannot do it quietly. The market can see that someone is selling, a massive, desperate seller, and prices move against you as you sell. Over 3 days, January 21st, 22nd, and 23rd of 2008. Societe Generale systematically closes out Jerome Kerviel's entire position. The loss, 4.9 billion euros. At the exchange rate at the time, that is approximately $7 billion. Gone in 3 days. It is the largest trading loss by a single trader in banking history at that point, and it sends shockwaves through global markets. January 21st, 2008 becomes one of the worst single days in European stock market history, in part because of the sheer volume of selling coming from one French bank, unwinding one man's hidden trades. Jerome Kerviel is arrested. He does not deny making the trades. He admits everything. But then he says something that makes the case far more complicated than anyone expected. He says he was not acting alone. He claims his managers knew that the profits he was generating, real profits in the good months, were too large to go unnoticed, that his superiors looked the other way when the numbers were good and only acted surprised when the losses came. Societe Generale denies everything. The investigation that follows is messy. The bank is fined by French regulators for inadequate internal controls, meaning the systems designed to catch exactly what Jerome was doing were not good enough. At trial, Jerome is convicted of breach of trust, forgery, and unauthorized use of bank computers. He is sentenced to 5 years in prison, 3 of which he actually serves. He is also ordered to repay Societe Generale 4.9 billion euros. Jerome Kerviel makes approximately 100,000 euros a year as a computer consultant after his release. He will never repay that debt, not in 1,000 lifetimes. In 2016, a French court actually reduces the civil damages, acknowledging that the bank's own failures and oversight contributed to what happened. But the 4.9 billion euros was already gone. No court ruling brings that back. Here's the thing about Jerome Kerviel that most people miss. He did not steal the money. He did not move it to a secret account. He did not buy mansions or live lavishly. He drove a modest car and lived in a small apartment. He was gambling, trying to prove himself, trying to make numbers big enough to be taken seriously on a trading floor that valued nothing else. And the bank that trusted its internal controls to catch exactly this kind of behavior, the kind of behavior a back office employee would know how to hide, failed to catch it for 2 years. Societe Generale survived. They raised capital, absorbed the loss, and continued operating. Jerome Kerviel served his time and now gives speeches about the culture of banking. And the 4.9 billion euros, nobody got it back. It did not go anywhere. It just ceased to exist.